Good morning. It's Jeffrey Christian of CPM Group. It's about 11:30 in the morning here in New York on Tuesday, the 30th of July. I have a lot of ground I want to cover. I want to talk about the Fed. The FOMC, Federal Open Market Committee, is meeting. They'll have a statement tomorrow, and our expectation is that that statement could, the market reactions to that statement may be one of disappointment, and you could see assets across a broad spectrum decline on a short-term basis. I want to talk about that today. Gold right now is trading around $2,430. It was $2,437. And silver's around $28. I will talk about our short-term market and price outlooks for gold and silver at the end of this video, so stay tuned. First off, the Fed looks at employment and inflation. That's its charter. It does not necessarily pay attention to the stock market. That's not its job. As a result, you sometimes have a lot of people in the stock market and in precious metals markets and other financial markets who hope for and wish for things that are not likely to occur, like the Fed's going to lower interest rates. Our expectation is that this week the Fed will reinforce what it's been saying recently. It will not necessarily tip its hat that it's going to lower interest rates in September. There are a variety of reasons for that. And that means that the markets, equity markets, bond markets, currency markets, precious metals, oil, copper, are likely to be disappointed. And in that environment, asset prices could be hit and move lower on a short-term basis this week. As I said, the Fed's job is to pay attention to the real economy, to try to maximize employment and keep inflation under control. That's what it does. That's what it says it does. Those people who say, no, the Fed cues off of the stock market, they're just wrong. That's fabulous, right? Now, if you look at real economic data, it shows greater strength rather than a weakening economy. CPM Group was expecting that the economy would be weaker by now than it has been. But second quarter GDP, 2.8%, pretty good. And a lot of other economic indicators tell us that the economy is doing a lot better than it would. If you look at employment and unemployment, if you look at inflation indicators, you can see that. And that's about what we're about to do. The real economy suggests that the Fed and other people who actually look at the real economy with non-fabulous minds and eyes see a greater risk at this time toward higher, more persistent inflation and not economic weakness. As a result, the Fed will try to err on the side of caution and hawkish policy rather than dovish policies, as far as we can tell. We'll find out tomorrow. There are side issues. The Fed does look at the stock market, but it looks at it out of the corner of its eye. It doesn't set policies based on the stock market. I know there are people who say that, but those are the same people who say that gold should be $10,000 an ounce and silver $500 an ounce. And if they're not, it's because of some suppression conspiracy. They've been wrong all of their lives. They'll continue to be wrong all of their lives. The Fed is also well aware of the market's persistent misreading of economic conditions and Fed expectations. By the way, the Fed hardly pays virtually any attention to gold, and it pays none whatsoever to silver. The Fed also looks to politics, and it tries not to make changes before presidential elections. It did raise interest rates in the third quarter of 1992 in advance of the 1992 presidential election. George H. Bush lost that election for a variety of reasons. I'll mention one in a second. But he continued to blame the Fed raising interest rates as that's what cost him the election. What cost him the election was that we had had a recession in 1991, and we had come out of it. It was a relatively short and shallow recession. We had a savings and loan crisis. We had a real estate crisis. They created the Resolution Trust Corporation to deal with that, which it did for $200 billion over about 4 or 5 years. as opposed to the trillions of dollars wasted in 2008, 2009. And the U.S. economy was recovering in 1992, but people didn't feel it. And George H. Bush continued to look at the aggregate data and said, I don't know why people are complaining. We're not in a recession anymore. Things are better. And they were better in the aggregates, but they weren't better for most people. And he didn't read the fact that people were suffering. Very similar to a situation that we had until recently here in the United States. So as a result of that and other experiences, the Fed tries not to change interest rates just before a presidential election. It doesn't want to necessarily see it have people saying that it is meddling with an election. In that way, the Fed is in stark contrast to the current Supreme Court. So let's look at the economy. Employment levels are at record levels, more than 160 million people working. They don't show any need for lower interest rates to stimulate employment. In fact, there's a large group, there's a very large number of unfilled jobs. And part of the problem is a number of people deciding not to work in the enter in the workforce. But employment is very high, it's at record levels, and it seems to be pretty good. Unemployment has risen to 4%, which makes it about the lowest level it's been since 2007. And if you look at that as a brief period of time, you can go way back to like 1990 or so, or even later. It's very low. Unemployment doesn't show a need to lower interest rates to stimulate the economy. So from the Fed's perspective of employment and maximizing employment, doesn't seem to be a call for lower interest rates at this time. There may be, maybe in the fourth quarter, but not at this time. Related to employment and unemployment, real economic activity, real GDP, shows no signs of needing lower interest rates. It's been rising steadily, and it actually is doing pretty well. If you look at it in a percent change, 2.8% actually real GDP in the second quarter might actually suggest the need for higher rates. Not really, but it definitely doesn't suggest that we are in an imminent danger of a recession and that we need to lower interest rates to help the economy. So there's no real economic factors there. Inflation does not suggest a need for lower interest rates. It has come down from that 2021 post-COVID peak of about 8%, 9%, but it is still higher than the Fed would like to see and most of the rest of it see. Inflation's still a problem, and that doesn't suggest lower interest rates. If you look at it on a month-to-month basis, it's harder to see because of the volatility there, but you can see that it actually dropped below. I have some charts on CPI. This is year over year, and you can see both headline, the blue line, and all items less food and energy are both declining, but they're still 3%, 3.3%, 3.3%. They're still much higher than the Fed and others, including myself, would like to see. If you look at it on a month-to-month, you can see the last couple of months have shown some pretty strong weaknesses in the deceleration of inflation. You're actually seeing some prices decline because people don't understand there's price levels and then there's price inflation. And inflation is the increase in price levels. Price levels are very high, and people would like to see them lower. You don't necessarily want deflation or general price deflation, but we still have high prices even as the rate of increase has declined, and in the most recent month, it was basically flat. On a producer price level, again, kind of persistent there. They're not really seeing signs that we should let up our inflation fight. And you can look at it that way too. Just for your information, here's the S&P 500 record levels. Yeah, it's come off. It could come off a lot more. It could come off a lot more tomorrow or Thursday after the Fed makes its statement. And this is the S&P volatility. And you're hearing people talk about the increase in volatility, and you can see a little bit of an increase here, but at very low levels. So the scope for a non-catastrophic drop is there, but it's not going to be a catastrophic collapse of the equity market. Not that the Fed cares. Let's turn to gold and silver. Our most recent ultra short-term trade recommendation for gold was on the 19th of July. A week earlier, we had said that we thought the gold price, which was trading around $24.50 at the time, we had said that we thought the price could range between $2,400 and $2,500. Got up to almost $2,500, then it fell to just below $2,400. So on the 19th, we said we thought that the price range could be $2,300 to $2,500 over the next few weeks. The price was trading around $2,408 at the time. As I said earlier, it's gone up to $2,437 today. Our view is that the price could be volatile. It could trade down sharply. A Fed comment tomorrow could take the price down to 2,380 or even lower. We're standing by the idea that the price could range as high as 2,500 and as low as 2,300 over the next few weeks, given the volatility politically and in the price itself. Our suggestion back then was that investors who wanted to continue to hold their physical metal should continue to hold their physical metal because of long-term economic and political concerns, but they could buy a put and a call to protect themselves against the lower price and actually to profit in the event that we were right and the price did move sharply lower and sharply higher over the next few weeks. So short-dated puts and calls to take advantage of short-term market moves while maintaining one's long-term holdings. Silver prices shown greater weakness. Our most recent silver trade recommendation back on the 19th, we made one, I believe, that was a sell, and the price had fallen to the level that we had targeted. So we issued another silver short-term, ultra short-term trade recommendation on the 25th of July when the price was $27.80. And we suggested that it could fall to $27.20 in the short term. And quite frankly, an FOMC comment tomorrow could actually do that. So we're looking for volatile prices. We're looking at a risk of a spike down tomorrow and Thursday due to market disappointment that the Fed doesn't necessarily say, oh, we're going to lower interest rates just before the election. But we're still on a longer-term basis expecting higher prices. Couple afterwards, I have a lot of other things I wanted to talk about, but we're just out of time already, and I want to keep this short. If nothing else comes along that's more compelling, I hope to discuss in our Friday video potential silver supply responses to higher silver prices. We are, as you know, if you listen to these, expecting higher silver prices over the next several quarters, possibly moving to record quarterly average prices of that time. And I would like to discuss how much silver might come into the market from investors selling above ground refined holdings of silver bars and coins that they have, from secondary supply. I'll show you what happened in 1980 when the price spiked up from $5 to $50. And also mine production on the longer run. I'd like to talk about that Friday unless something more compelling and urgent comes along. Also, we've been picking up commentary recently about a large secret, not a large, but large secret and unreported central bank gold buying in May and June. Central banks' reported purchases were actually much lower in May and June. Don't believe the rumors. I guess I say here that it's wishful thinking from fabulists. It also might be marketing hype. And there's a lot of stuff that happens in the gold market that could be misattributed to central banks buying for monetary reserves, but it's not really what it is. Another point I would like to have talked about is gold promoters. They talk about unfunded long-term U.S. government liabilities. We have $34 trillion of federal debt right now, but if you look at the next 10, 30, 50 years, there's all these unfunded government liabilities. We have that. They never talk about what projections are on the other side of the ledger. What are the projections for U.S. government long-term income, and how does that compare to those, quote, unfunded long-term government liabilities? If you look at the balance sheet on both sides, you get a radically different view, and you can actually sleep at night. Something that we probably should talk about in a future presentation. 2 novels, I sometimes give you nonfiction to read. 2 novels that are timely right now. It Can't Happen Here. Sinclair Lewis wrote that in 1935. He was pretty much shot as a novelist. The Babbitt series of books were fabulous in the 20s. By 1935, his fiction writing skills were kind of down, but it's a fabulous, fabulous political tract. It had to do, 1935, the first term of FDR. There were a lot of people who thought that we would be moving toward a fascist state. William Randolph Hearst in 1932 had urged Franklin Delano Roosevelt to declare martial law once he was inaugurated. He didn't. His Secretary of State in his memoirs said the only person who kept the United States from becoming a dictatorship in 1930s was FDR. It's true. It Can't Happen Here lays out a really interesting fiction of a populist who's full of lies and bullshit and bluster, who becomes president and basically declares martial law and starts establishing an authoritarian country where individual freedoms are taken away. And it's really interesting, some of the corollaries with the current situation. The book stunk as fiction, but as a political prophecy, it worked. Went out of circulation. It came back in circulation during the George W. Bush administration, when, as you probably know, a number of people were betting that there wouldn't be an election in 2008. In 2010, Gary Steingart wrote Superstad True Love Story, which was set in the very near future. And it was a dystopian view of America run by consumerism and the People's Bank of China and a government in the United States that was subservient to the Chinese government. Very frightening book. Put those two together, and everything I said about, hey, unfunded liabilities being offset by projected income can be flushed down the toilet. They're really good books, and they're very timely right now if you want to read them. If you don't, go away. No, if you don't, you can read nonfiction by going to CPM Group's website. Buy our gold yearbook, buy our silver yearbook, buy our platinum group yearbook. Each one costs $160. So for $480, you can have the definitive, accurate, unbiased reports on these metals. You can read about these things and understand above ground inventories, investment demand, the way markets work, supply, demand, in the case of gold, official transactions. And that'll help you cut through the nonsense that you hear in these markets on an ongoing basis. If you want, you can buy those reports. There's a lot of free reads. There are presentations on the briefings of those reports that you can download from there. And you can write to us at info@cpmgroup.com and say, CPM Group, how can you help me invest better, more wisely in precious metals and commodities? I'll talk to you Friday. Take care of yourself. Take care of those around you. Try to do something good for Mother Earth. She's waiting for us to do something good for her.